Risk management. As the saying goes, if you fail to plan, you plan to fail. Risk management in trading is where you assess the potential upside of a trade against its potential downside, and then develop a plan to exit a trade if it goes the wrong way. Minimizing loss is the key, preserving capital is the aim. In this video, we're going to discuss a lot of competing principles, but this is by design, so you can pick and choose what you think could work for you and your trading styles. And simply put, the biggest mistake beginner traders make is that they don't even bother to plan their entries or exits with risk management in mind. But like with different trading styles, everyone's approach to protecting their capital should be slightly different and unique to them, unique to the market conditions they are attempting to trade, and unique to the time frame they are using. And the debate surrounding the use of stop losses will of course linger large over these proceedings. Is a stop loss more of a hindrance than a help in some situations? I would argue yes, but also I would argue people just need to get better at placing them. But I do believe that the debate should not be about what specific strategy you use, but just that you ensure you have a strategy, as ultimately that's what burns people in crypto, the absence of consideration for risk management. But what is a stop loss for the uninitiated? Well, a stop loss is a risk management tool that traders use to limit loss or lock in profits on a position. When a stop loss is triggered, the exchange will automatically sell your coin or token when it reaches a certain price point. It is designed to help traders exit their positions before too much loss to stop loss is incurred. Here now are a few principles, therefore, to consider when employing stop loss orders on exchanges. Number 1. Whenever I enter a position, I have a predetermined stop. I know where I'm getting out before I get in. So what that essentially means in principle, before you enter a trade, you should already have planned out where you're going to take profits, where you're going to enter, and where your risk management is going to be employed. For example, where is your stop loss going to be? Number 2, the position size on a trade is determined by the stop, and the stop is determined on a technical basis. Let's break that down for a second. So the position size on a trade is determined by the stop. If you have the stop loss in a really good position, something which supports a good risk to reward ratio, and it's suitably protected behind certain price barriers, then your position size may be a little larger than if, for example, you have a stop loss which you feel is a little bit risky. So a better risk reward ratio means a larger position size, but a more risky risk reward ratio, because you're struggling to get the stop loss in a good place, means potentially you should have a smaller position size. And the stop is determined on a technical basis, essentially means that you shouldn't be using like a rigid 10% decline stop loss. Your trade should determine where the stop is based on the technical fundamentals of that chart, and not the fact that, well, I always use a 20% stop, because that isn't being flexible and it isn't going to allow you to put a stop loss in a safe place without risk to you and your assets. Number 3, I always place my stop beyond some technical barrier. This essentially means that you should make sure your stop loss firstly has a bit of distance between where you've entered and where you're going to exit if things go wrong. But you need to make sure, of course, that potentially there is a moving average between your entrance and your stop loss. So there's a set of buyers to protect your stop loss from getting hit. Or potentially if you've bought the breakout of a triangle pattern, then the stop loss might sit just underneath that triangle pattern to ensure, of course, that the price doesn't dip down, get you stopped out before continuing higher. So always place your stop loss behind some technical barrier on a chart, whether it's a trend line or a pattern or a moving average or even an order block. Number 4, I place my stop at a point that is too far away or too difficult to reach easily. This means you have to get a good balance between not having your stop loss too close to the current price action, otherwise it risks getting triggered by liquidity hunters before your trade has even had chance to be realized. But also you need to make sure it's not too far down, because then if there is a black swan event, you're going to incur a significant loss on your trade. So a nice balance between not easily reached by the price action, but not too far away that you're going to incur a significant loss and that it's messing up your risk to reward ratio for that particular trade. And just before we move on, here is a quote which can provide some food for thought with regard to stop losses. Place your stops at a point that, if reached, will reasonably indicate that the trade is wrong or invalidated, not at a point determined primarily by the maximum dollar amount you are willing to lose. So here is a quick summary of some stop loss techniques. Firstly, we have fixed points, which are essentially a percentage decline strategy, which means they are a rigid 10-15% for every trade. They're not flexible, and because they're not adapting to the setup which you're trying to capitalize off, they will quickly start working as liquidity hunters find them and get you out of your trades before they've even begun. The next is natural price action, which of course means that your stop losses are going to be flexible and adaptive. They will always use the context on a chart to determine where they sit, and they can deal better with volatility because you're considering where the price will go potentially before you place your stop loss, as opposed to a rigid 5, 10, 15%, which doesn't take these things into account and therefore more liable to get triggered. And finally, we have no stop loss, which of course is very high risk. Okay, switching to a live chart now. So we have a moving average here. This is the 2-edge MA sweeping in here. We have the price action currently in an uptrend. We have this kind of bull flag, falling wedge, and then we have a red bearish order block here and some bullish green order blocks here. So where are the buyers, where are the sellers? Buyers are here, sellers are here. So there is a potential trade opportunity between these two order blocks. So we've also, as we said, got this falling wedge or bull flag to trade off. And of course, we said we've got this moving average to consider sweeping in underneath. So where am I going to enter? This is the first thing, of course, when you're thinking about risk management. Where are you going to enter, and how is that going to impact your risk management and your stop loss? So let's have a look. We've got a nice order block here. We've got a solid trend line here, which the price action has bounced off. We've had this low wick here, which immediately was bought up. So we could have bought the retest out of this pattern here, or we could have, of course, bought this support line following a retest, which hasn't happened yet. So entrances are key, of course, to good risk management. So entering at the right place gives you options if a trade goes bad, and entering at the wrong place gives you less. I'm trying to find a place to enter which would give me the most options. And this trend line, honestly, seems pretty decent. Maybe I could put it there. That could be my entrance, but we've got quite a bullish context at the moment. So I'm just going to say, you know what? I'm going to enter here on this line. I'm going to hope, of course, then the price action comes down. I'm going to try and enter here. Really straightforward. So let's now start considering my risk management. So I'm using the long position tool in TradingView. So I'm going to enter here. Let's have a look. Where am I going to take profits? You've got to think of that next. Don't ignore that. Don't just think, well, I don't know yet because I don't know how high it's going to go. Forget that. Have a plan, right? So we've got this huge order block here. We've got a wick up here. I'm thinking, you know, that's fine. Maybe here, 29%, 30%. Sure, okay. I'm quite bullish, so maybe I could go up here. So I'm going to put my take profits price point there. Now let's have a look at my stop loss. So the price action came back down here. It's retested this line, so that's kind of the floor from this move. So you could have your stop loss here, right? And that gives me quite a nice risk reward ratio. That's great, 4.62. But I feel that's a bit tight for me. If the price actually comes back down here, we could have another wick down to this level. So it's a bit too close for me. So I'm going to consider this level here. Right, so how are we looking? Risk reward ratio is about 3, and that's my price point I'm happy with. So, you know, I think this is a good fair balance. So what have we got protecting our stop loss? Okay, is there another trend line which we've missed? So there's got a trend line here. Okay, we've got this trend line. So if we're going to enter here on the retest, so you've got this trend line protecting, you've got this trend line protecting you, you've got an order block protecting you, and you've got it with a reasonable risk reward ratio. That works for me. That's great. But I just want to draw some lines in the sand which represent when a trade is invalidated. We have this bull flag here. We've had this breakout, of course, already. So any break below this line doesn't necessarily invalidate a bullish retest here, because we've got a little bit of order block which could be eaten up. So certainly if the price action comes down and it enters this order block, to this degree. The premise of the trade is still probably intact, so there's no big deal there. However, where is the line? How low would it have to go in order for the trade to be invalidated in my mind? So certainly coming back down here, you know, I think probably below my stop loss, right, is the line, because here you've kind of got this last resistance line for the price action before the breakout. So this level here is going to act as that kind of line in the sand, that trade invalidation line. So I'm going to give that line a bit more significance on my chart, so I can kind of see that it's a decent line. And because I think it's going to be the invalidation line for my trade, I'm going to make it red so I can see, right, that's where my stop loss is. It's dead on the invalidation line. But even if I wasn't using a stop loss, this line in the sand would tell me that if the price action reaches it, having entered here, I need to start thinking about exiting, because the premise of my trade is no longer intact. And that's how you do it. But let's just take a quick look at how we could use moving averages as well as a healthy price barrier for our stop losses. So let's just zoom in down here very quickly. Okay, so here, of course, the price action was in a downtrend. This was just before the election in the United States. There's November the 5th. And then, of course, the market reacted to the election news, and then a price action broke above this moving average for the first time in a little bit, which had previously been acting as resistance to the price action. And now a whole load of buyers will show up as the price action attempts to retest this moving average, and away we go. So if I was going to trade this, the moving average is going to be an excellent natural barrier to protect my stop loss. So there's my trade entrance, and let's see where I'm thinking of taking profits. So I'm going to get my long position tool. That's my entrance point. That's my plan, at least. That was my plan. I'm going to take profits to the next trend line. Yeah, so that's a resistance line, clearly. So this trend line is where I want to be looking to take profits, as that's where the sellers are. The buyers are here, the sellers are here. But let's figure out where my stop loss needs to go. So obviously that's not a great risk reward ratio. So let's get this sorted. So obviously I need my stop loss to be below this key trend line, but we've got this moving average as well, so we can place the stop loss below that, comfortably having two kind of natural barriers to the price action protecting our stop loss. Okay, so we've got a level here in the price action. There's a nice, let's just put that blue for now. So there's a trend line there as well. So I would like to be below, of course, that 200 moving average, but also because it's quite close to where I've entered, I'd like to get below perhaps at least this trend line, and ideally maybe that one. So I've got some natural barriers. So, okay, let's have a look at my risk reward ratio. It's 2.4, not as good as I'd like it. So let's reevaluate. Is my take profit price point a bit liberal? We're in a bullish context. So we could do this, we could adjust it, we could put it up here, which helps my risk reward ratio. And as you can see, the price action did go up here, but I'm not particularly comfortable with that. That is what I want to have. That's the next kind of place to take profits. So that's what I'm going to do. I've got the 200 moving average. I've got this trend line. I've got this one. I'm okay with my stop loss being here. And then we can get that kind of 3.2 risk reward ratio. So having looked at this, looked at where the buyers are, how many barriers they are, it's not perfect, but I'm happy with it. I'm comfortable with it. So I'm going to enter here, hopefully to capitalize on this bullish move. But if it doesn't happen, the price action has to recede through 1, 2, 3 barriers before it hits my stop loss. I can live with that. Again, we need to look at where the invalidation points are on this trade. Where's the point that this trade invalidates? So really for me, the trade invalidation is pretty much kind of here, this line. This is essentially it, really. Anything below here and it's kind of game over for any bullish context. So here's my trade invalidation line. So I know there's a line in the sand that if the price action crosses, that it's like, okay, right, I've got a problem. So it's always good, even if you've got a stop loss in place to protect you, always label your chart with an invalidation line so you can kind of see if the price action crosses will mean that the bullish context of your trade is no longer in play, because that can help you make unemotional decisions in an emergency situation by clearly having a predetermined line in the sand that you know if the price action crosses, you need to act. And this is the game. This is how you do it. So stop losses should be behind natural price barriers, not on, and with enough room to be safe from a random wick here or there to avoid liquidity hunters trying to take your money. Also, if you are committed to a percentage decline strategy, i.e. a fixed 10% or 15% stop loss for all of your trades. That if you do insist on using that, just remember that crypto is much more volatile than stocks, where the stock market traditionally uses percentage decline a little bit more rigidly. Give yourself a bit more room for your stop losses with crypto because there is more volatility. So make sure there is that extra little distance for your stop loss if you're used to trading in the stock market. As for crypto, you could get some crazy swings which you're potentially not used to seeing in more traditional markets. And also, stop losses will vary depending on the time frame you're trading on. Typically, you'll have larger stop loss gaps for higher time frames and smaller stop loss gaps for lower time frames. But let's take a look at that in a little more depth. For short to medium term trades, your risk management approach should contain the following. You should have a pre-planned and strict exit price point to minimize loss. You should be focused on smaller moves with a clear premise. For example, the breakout of a falling wedge. You should have a predetermined trade invalidation line, which will allow you to recognize when the trade is no longer going to go as planned. And you should be pre-prepared to exit at a loss if the trade does invalidate. You should also have a predetermined risk-reward ratio, for example, 50% profit versus 10% loss, so you can properly assess whether the trade is worth doing. For long-term trades, your risk management approach will be slightly different and potentially slightly more simple. Your exit to minimize loss will be based on wider market sentiment. You'll be more flexible in terms of your exit price point. You'll be less concerned with minor dips into loss and more focused on the bigger moves across longer periods. And you'll essentially hold on for dear life until in significant profit. So 2 approaches to risk management based on the type of trades you're engaging with. Now we're going to look at 2 risk management strategies. Trade invalidation versus percentage decline. The trade invalidation strategy allows for flexibility and the potential to exit with 0 to minimal loss, but it does not protect from black swan events or large unforeseen market swings. Trade invalidation strategies are more emotional to trade, and you have the potential to lose everything. On the flip side, the percentage decline strategy guarantees a predetermined percentage loss if the trade invalidates, but it protects from black swan events or large unforeseen market swings. Percentage decline strategies are less emotional to trade, and the potential for loss is capped. Let's now take a look at both of these approaches in a real-world trading scenario. So in this scenario, I entered a short trade here. I'd been assessing the price action and it had had 2 previous attempts to break to the upside against probabilities, and it failed to do so while we had these wicks and minor little breakdowns here. So 70% chance of a break to the downside. The patterns existed for a while. I'm expecting to enter here and for the price action to break down and hit my price target. However, because Bitcoin's price action is very bullish, it has broken to the upside. In this instance, I'm using an invalidation strategy for my risk management, which means I will wait for the premise of the trade to be invalidated before I look to exit. And in this case, with a rising wedge, an invalidation of this pattern will be a break against probabilities to the upside. Now, this is exactly what happened. So as a trader, I'll be watching the price action come down, not break through this support line, and then continue upwards. But I won't exit the trade until a point of invalidation has occurred. So in this case, the second the price action comes up from this line and then performs a retest is the point of invalidation. In these instances, the price action came up but came straight back down again and failed to flip this line from resistance to support. But in this instance, the price action came up, successfully flipped the resistance line to support, and then continued upwards. So I would be looking to exit on the retest, as that is the point of invalidation for my trade. I would have incurred a 2% loss versus 8% potential gains, but that is how you would use an invalidation strategy for your risk management. You would wait for the premise of the trade to be invalid and then exit. If I was trading the same setup with a percentage decline risk management strategy, this is what would happen. I enter the trade here, again, presuming the price action is going to break down because of the probabilities of this particular pattern, but it does not. And in this case, I have a stop loss and automatic exit order on the exchange where I bought in. So when the price action comes up to this upper trend line and hits my stop loss price point, I exit the trade at a guaranteed loss of 2.4% in this instance. So you might be saying to yourself, these two strategies had exactly the same outcome. When you were using a point of invalidation strategy and you exited on the retest, you lost 2.4%. And with the percentage decline strategy, which employs a stop loss to automatically exit the trade, again, I had 2.4% loss. So you're probably asking, what is the point I'm trying to make? This is the point. In this updated scenario, instead of the price action breaking to the upside, it puts in another fake out here and then rolls over and hits my price point. If I was using a percentage decline strategy where I have a stop loss automatically exiting my position if the price action touches it, I would have essentially been stopped out, which means the price would have come up, it would have hit my stop loss and then reversed and come back down to hit my price target. So if I was using a percentage decline strategy, I would have exited the trade before I'd even had the chance to be in significant profits. However, if I was using an invalidation strategy for this particular scenario, I would have entered here, seen the price action reverse, but seeing it pop its head out above the trend line, not successfully flip it from resistance to support because it doesn't put in a successful retest, not exit the trade having seen this, and then just ride it all the way down until it hits my price target, a successful trade, benefiting from the added flexibility using an invalidation strategy offers. However, as you can see, if the price action as it did goes to the upside, the stop loss can protect you from greater loss. But it also makes you susceptible to liquidity grabs and fake outs when the price goes in the wrong direction and then reverses quickly. And just to clarify what a stop loss is, it is a sell order on a crypto exchange like Binance or Coinbase that will automatically exit a trade if the price action reaches a specified point, typically if the price goes in the wrong direction. It may look something like this depending on the exchange. It is designed quite literally to stop loss. How you approach risk management should be unique to your trading style, with different strategies working for different individuals. Plus, you should be employing different strategies for different market conditions. For example, long trading in bearish conditions benefits from a tight stop loss, whereas bullish markets will give you more opportunities to exit organically, perhaps with an invalidation strategy with minimal to no loss. Adapting is key here. To summarize, let's return to our comparison list of the two risk management strategies we've been looking at today. So a trade invalidation strategy allows for flexibility and the potential to exit with zero to minimal loss. It doesn't protect from black swan events or large unforeseen market swings. It's certainly more emotional to trade and you have the potential to lose everything, but it has a manual exit which protects you potentially from fake outs and liquidity hunters. Whereas a percentage decline strategy guarantees a predetermined loss if the trade invalidates, but it does protect from black swan events, large unforeseen market swings, and is less emotional to trade, and your potential for loss is capped. But it has automatic exits using a stop loss, which makes your trades susceptible to fake outs from liquidity hunters. Having a plan, any plan, to stop emotional trading will improve your success rate. Forgetting to plan is forgetting to win, and if you don't consider risk management before entering a trade, you are just rolling the dice. At which point does this breakout trade become invalidated? A, B, or C? The answer is C. A breakout trade is essentially where you're trying to flip a trend line from resistance to support. Until you know whether or not that attempt has been successful, your trade is not invalidated. So even though at point A the price action has come back down below the trend line, it hasn't provided any evidence that the attempt at flipping this line from resistance to support has been a failure. Case in point, the price action comes back up. It then comes back down. Doesn't offer any confirmation that this line has flipped from resistance to support, but still doesn't provide any evidence that it's not going to happen. Again, the price action comes back up. A potential for this flipping from resistance to support is still on the cards. So point B is not where the trade becomes invalidated, but it is a lower high, and that is a warning sign. But it's only till the price action comes back down again and then puts in a bearish retest of this trend line, giving us the evidence that this is still resistance and not support. So this is the point where the trade becomes invalid, and this is the point where I would be looking to exit if I was employing a invalidation strategy in terms of risk management. Risk management isn't about having a rigid 10% or 15% stop loss for every trade. It's about adapting to the type of market conditions you find yourself in. Are you trading a bear market or a bull market? And how will that impact your approach? Are you spot trading or leverage trading? Are you hodling or day trading? What's your position size? The ultimate goal, though, is to use crypto's inherent volatility to your advantage. You enter trades at price points that are likely to offer the most exit points if the setup invalidates. You take profits not at price points that represent how much money you want to make, but where the least risk lies and the best chance of profits sits. You could get cute and use trailing stop losses all the way up a bull run, only to have yourself exit your positions prematurely because a rigid decline parameter decided your exit for you, as opposed to wider market signals. Whatever your approach to risk management is, though, the key thing is to have considered every possible scenario before entering a trade, employ stop losses where they're appropriate, and to always have a predetermined exit plan before clicking that buy or sell button. If you can do that, you'll do all right. But before we go, I just want to mention something called the trader's tuition, which is the cost you must pay while making mistakes when you're first learning. So when you do first start, you will lose more trades than you win. But after a while, you start breaking even and not making as big a losses, perhaps because of an improved risk management strategy. Then after lots more practice, you start winning more trades than you lose. And as you gain more experience, you will increase your win rate and take fewer and fewer losses. So don't let a few failed trades discourage you. That's it for now. Catch you in the next one.
Ola Prime, trade with transparency.